money, the first thing the bank is going to do is look at the total of all your current assets. So you see those on there, they total up 90,000, and they're going to look at the total of all your current liabilities, and they total 50,000, and your banker will be so happy that you have more current assets than current liabilities, and you're going to be more likely to get the loan. And you can see how quickly that happens, right? I can just look at that balance sheet and know immediately your state of liquidity, or maybe not liquidity, right? Liquidity is a good thing in accounting. So, all right, so we're going to talk about why, there's a certain order for these items on the financial statements. Even within the current assets, you're going to learn that there's a certain order. I can't put them in alphabetical order. I can't put them in order from, you might be looking at that and saying, oh, I think I know, it's in order from largest to smallest. I've got 49 down to 18. Well, no, I'll hold that secret till we get to another slide. There's a certain reason why we put these in this order, right? So there's my assets, and look at the bottom there. They total $185,000. Now, on the other side, you see the caption liabilities and owner's equity, and go to the bottom and you see a total for liabilities and owner's equity, and bingo, there it is. You see the same number, right? 185,000. So without doing the math, you already kind of see the accounting equation that assets equal liabilities and owner's equity. That's why it's a balance sheet. It's in balance. And so we're going to get into all these little nuances of, why are these current liabilities in a certain order? And then, what's this owner's equity thing at the bottom? So that's just, we'll come back to this. And that's just food for thought as we go along. I'll probably flip back to that. Now, as I said, here's the accounting equation. It governs everything that we do in accounting. We've got this double entry thing. Everything has to balance. Okay. So if you don't like math, you're probably ready to check out on me. So I don't care about this balancing thing. So there's my equation: assets equal liabilities plus owner's equity. Now, this is funny. I taught elementary accounting for many years. I mean, I taught advanced accounting as well, but I really liked the elementary accounting because people haven't had a chance to develop bad habits yet in accounting, and they haven't been influenced. They've always heard bad things about accounting, but I wanted to get them early on so I could give them the foundation that they wouldn't think such bad thoughts about accounting. And I discovered that accounting, for most people, they think of debits as being something good and credits as being something bad, or maybe vice versa. Think about a bank, right? So when you get your bank statement, if there's a debit to your bank account, that's a bad thing, right? Because it's taken money out of your bank. So I would have students come and say, well, debits are bad. And I said, debits are not good or bad. They're directional. And the direction of the debits and credits has to do with that equation. So if you look at that equation, you see that equal sign, right? And on the left side of the equal sign, what do you see? Assets, okay? And on the right side of the equal sign, you see liabilities and owner's equity. And all we're doing is saying the left side represents the resources. That's what assets are. They're so you can almost say assets are good, right? You want to have more assets than liabilities, certainly. So you've got your resources, and then the right side are the claims to those resources. And what I mean by that, so when you first started your business, and let's say you needed to buy some special piece of equipment, and let's say you didn't have the cash to buy that equipment. Well, there's only two ways you could acquire that equipment. You could either, one, borrow the funds, right, to acquire that equipment, which would create a liability. A liability just means you owe somebody. Or you yourself could contribute the cash, or maybe you could get another investor or another owner to come in and fund that, right? So your resources that you have, the assets that you have come from either borrowing or from owner contributions. And that's all that is. It's just left and right. Resources are your assets. On the right side of that equation, on the right side of your balance sheet, it shows all those claims to those resources, whether banks have claims to them or whether you, the owner, has claims. Okay, so there's just another look at that for those of you that are visual, right? There's your assets, they represent economic resources, and then those liabilities, how did you finance those resources, either from creditors or from owners? Okay, so let's get a couple of definitions in here. If we're going to say that assets are good, the classic definition of an asset is that it provides future economic benefits. Okay, so think about something that would be in the asset category, cash, right? Cash certainly provides future economic benefits. It allows you to acquire additional assets, right? Pay your employees, pay your rent, pay your light bill. Accounts receivable, inventory. Inventory certainly is an asset, right? It's providing future economic benefits. If I've got a warehouse full of inventory, what is that future benefit? I'm going to be able to sell it. That's my benefit. I'm going to get some revenue. And you know, it goes back to, you have to have legal title to it and unrestricted use of it. We're not going to get into any legal stuff. Now, the categories of assets on your balance sheet, the two major categories that we think of are your current assets and then your non-current, or sometimes they're referred to as long-term assets. And your current assets are those assets that are either, you know, already cash, or they expect to be converted into cash or used up within the next operating cycle. So for most of you, your operating cycle is going to be a year, right? Whether you're doing a July 1st year to June 30, a January 1st to December 31st, there's no rules about what you have to have for a fiscal year. But we're going to say that for something to be classified as a current asset, you expect it to be turned into cash or used up within the next year, within the next balance sheet date. Now, here's the rule. When you look at your financial statements, you will see that those current assets are in order of liquidity. So those cash is first, obviously, because cash is the most liquid asset. And then it's going to go down the list. Those assets that are going to be converted to cash next are going to be listed in that order, that descending order. So we'll take a look at those. And non-current assets then are anything else that's not current. And so we put them in order, and we kind of do the same thing. We kind of put them in order of liquidity. And as I look at the other ones, I'll explain that. But a non-current asset would be your equipment, right? If you have any land, some of you might have what we call intangible assets. That would be if you have any copyrights or maybe a patent or a trademark. Okay, intangible, you can't go out there and touch it or kick it, but it certainly has a value. It's certainly a resource of your business. Okay, so let's look at the order of liquidity and some of the common current assets. So cash, I think, is pretty self-explanatory. If you actually have any cash on hand, all of your bank accounts that you have, whether they're checking, savings, some of you may have certificates of deposit. We're not going to worry about the term cash equivalents tonight. And then following cash, the next most liquid asset that we have is called marketable securities. Now, a security is just a fancy name for an investment, but it's short term. So now investment, let's be a little bit careful here. An investment, you could, if you have extra resources, you might go out there and decide to buy some stocks, right? I have a friend who is just crazy about Apple stock. He's always checking the numbers for Apple stock. What's Apple doing? It's going up or whatever. So if you have equity securities, equity is a term used for when you have an investment in stocks, as opposed to debt securities if you're investing in the bond market, right? So I don't know if any of you are there yet, but heck, maybe in the future you'll be in that position that you can have these investments. Now, whether they are short-term or long-term depends on your intent at the time you buy those securities. So if I bought Apple stock today and I said, hey, I'm going to hang on to that forever. I'm going to wait. I'm going to buy it for $100. And I just know Apple keeps coming out with new iPhones, and 5 years from now, I'm going to be able to sell that Apple stock for $600 a share or whatever. Well, my intent then is not to sell it within the next year. So I wouldn't classify that as a current asset. I would put it in the non-current asset category. We can actually have marketable securities in both the current asset category and the non-current asset category. Okay, so these that we see here as current assets are those ones that I'm going to buy it today on November the 10th, right? And I intend to sell it before November 10th of 2021, right? My intention is to just quickly turn it around, so I'll keep it as current. Now, the reason that it's the second most liquid, any of you that have any mutual funds or have done anything with this, you know, it's so easy to trade our securities, even, you know, with Charles Schwab and Fidelity and all those types of organizations out there. You can say, okay, I'm going to buy this today, or I'm going to sell it today. And by the end, you can do that at 9 o'clock in the morning. And by probably 3 o'clock in the afternoon, the funds may already be in your account. So you can see how quickly the sale of marketable securities could be converted into cash. If you decide to sell your Apple stock, you don't have to wait 6 months for them to liquidate that stock and put those funds in your account, right? So that's how that one shakes out. Now, one that you probably do have on your balance sheet would be accounts receivable. I'm assuming that there's not too many of you out there that are on a cash basis only, right? So if you provide services or you sell your inventory, you have vetted your customers and have decided that they are worthy of maybe 30-day credit terms, right? So if I make a sale today, I give them 30 days to pay me in cash. Now, when you do that, we're going to look at that as part of accrual accounting just a minute. You have the revenue, but you don't have the cash yet. But you do have an asset. That accounts receivable represents an asset because you believe that in 30 days you will be able to collect that balance from your customer. Okay, so accounts receivable, you know, unless you have really bad customers, is most of us give 30 days, and you know, we know that we're going to get that cash within 30 days or maybe 45, right? We don't want to drag it out too much. We always have slow pay. Okay, when you all can figure out how to get all of your customers to pay within 30 days, let me know, okay, or let somebody know, because you will be rich if you can figure out the secret to do that. But most businesses, they're kind of happy if they can get everything collected in 45 days. Your goal is quicker, but you know, you'll take 45. So you can see accounts receivable, highly liquid, right? They would easily fit the category of a current asset. Now, what about inventory? Inventory is tricky because if you have a really hot product, you know that you could put it on the shelf today. You put out all your inventory today, and in another week, it could all be gone. That's what we all want, right? But then something new pops up and your inventory isn't popular or hot anymore and nobody wants it. So you can see that inventory kind of straddles the line there. You can, your intention with inventory is to sell it all within a whole year. Now, most of us don't want that. That's too long. We'd really like to liquidate our inventory as quickly as possible. But you can see inventory is not nearly as liquid as accounts receivable. So that's why we have this order. Now, prepaid expenses. This one is so misunderstood from people that are trying to get to understand financial statements. For one thing, there's actually two reasons why, and it's all about words, right? Here's this language thing again. The word expense. I told you 20 minutes ago that on an income statement, you see revenues and expenses. And here it looks like I'm telling you a lie, because now I'm talking about a balance sheet, but I've got prepaid expenses. Why are why am I telling you that there are expenses on the balance sheet? Well, the reason I'm telling you that is because I put the word prepaid in front of the word expense, and that changes the whole nature of that account. So let me give you an example. Let's talk about prepaid insurance. So if I go out there on January 1st and I have some liability insurance on my, on my warehouse or my office, and I pay, let's say I buy a 12-month policy. And let's keep the number simple here. Let's say I pay $1,200 for that policy. So that breaks down in a year's time, that's $100 a month. So the insurance company, and let's say the insurance company is not going to let me finance it. Let's totally leave out the financing. They want me to pay all $1,200 up front. So I write my check for $1,200 for the insurance. And what do I have? Do I have an asset? Well, I do have an asset. I have prepaid my insurance for 12 months. So I have provided future economic benefit over the course of this coming year. So on January 1st, if I were to do a balance sheet on January 1st, after I paid for that insurance, I would have $1,200 as a current asset in the category called prepaid expenses or prepaid insurance expense. Now, let's go down the road to the end of January, and I'm getting ready to do my financial statements. What has happened? The clock has ticked off 31 days in January, right? So what have I done? I have used up 1/12 or 1 month of that asset. So at the end of January, my prepaid asset has been reduced to $1,100, but now I have $100 of insurance expense, right? I have used up $100 of insurance. So that's why you'll look at a balance sheet and some, however you set up your accounts, they may just call it prepaid insurance, trusting that it's really prepaid insurance expense, but it's not an expense as you would see on an income statement. Because it's prepaid, it's providing future economic benefit. And so there's other things you can pay in advance. Sometimes you can pay advertising in advance, you can pay rent in advance, but the classic one is prepaid insurance. So I would say of all the balance sheets that I have looked at in my career, I don't think there's been one that hasn't had prepaid insurance. And this one, I have a new client, kind of new, a couple of years, and they expensed everything. So they would pay their $1,200 insurance policy on January 1st, and on their income statement for the month of January, they would have insurance expense of $1,200. And it took me a long, long time to convince their director of operations that this was not correct. I said, but my bank account balances, I said, that's not the point. You've got to get things in the right bucket. You still have an asset remaining for the other 11 months. Okay. So we're going to take another look at that when we get to this accrual thing. And I even have an exercise that I'm going to show you that hopefully, will click with you. Okay. The non-current assets. So as I mentioned earlier, those marketable securities, if you decide at the time that you buy them that you do not intend to sell them in the near future, you will move them down into the non-current asset category. And then you have the famous PP&E, which is your property, plant, and equipment. And so we have land, and we have, buildings, equipment, vehicles. Okay, these are long-term, because what you do when you purchase a piece of equipment, you have a couple of decisions to make up front. You have to decide the useful life of that piece of equipment, right? So if you buy a new computer, if you buy a laptop, you might say, hey, if I get 2 years out of that, that'll be great. I'll be really happy. And so you will give it a 2-year life. And everything that is in the category of property, plant, and equipment will be depreciated except for land. And we'll talk about depreciation as well, okay? So you will have to, you decide what's the useful life and then how long you want, and you'll depreciate it over that period of time. So obviously, the longer the useful life, the less your depreciation expense will be. However, the accounting police will be sure that you have, they don't prescribe the useful life that you come up with. They just want to make sure it's reasonable. So therefore, if you had a laptop on there and you had to go to bat with either the IRS or, somebody else who's looking at your financial statements and tell them that you've given that laptop a 15-year useful life, it's not going to fly, right? I don't know too many laptops that can last 15 years. So if you came up with 5 years, maybe, but certainly not more than that, as opposed to a building. You wouldn't want to take a building and say, oh, it's only going to last 2 years. Usually the typical useful life for a building is 35 or 40 years. That's the standard kind of accounting thing. So those are other things. When you look at a set of financial statements and you see things in those categories, you also have to know that behind those numbers, there's other decisions that have gone into that, such as what is its useful life, what kind of depreciation method are we going to use, and so on. And then we talked about intangibles, right? There's lots of intangibles out there. They don't get depreciated, they get amortized as well. So most of them, it goes with legal lives, like patents have 20-year legal lives and things like that. So I've picked up clients that didn't know those rules before. They had those intangibles on the books, but they were not aware that they should be amortizing those, okay, if they don't have a definite life. There's certain things that have indefinite lives, like trademarks and goodwill, but most of the others have a very definite life or a legal life. All right, so a couple more rules, and then we'll do something more fun, I hope. Okay, so the assets, they have to be on your books at what we call historical cost. And so all that means, and a lot of people get mad at historical cost, that means just the price that you pay for it. So let's say that 10 years ago, you knew that people were moving north of Denton, right? And they were acquiring land somewhere out there between Denton and Oklahoma, and they acquired all this land for $10,000. And now that's become a really hot real estate market, and the land that you paid $10,000 for is now worth $1 million. What are you going to want to do? Aren't you going to want to mark that up? Don't you want to show that on your balance sheet for $1 million? Well, guess what? You're not allowed to do that, because accounting, except for marketable securities, measures the assets on the balance sheet at historical cost. Okay, so it's not wrong. When you look at a balance sheet and you see the land on there and the equipment and the buildings, all you know is that that's the price they paid for it, right? That's the historical cost minus any depreciation. But the disadvantage is it doesn't reflect its current market or appraised value, right? So oftentimes that number is undervalued. But we just have to have rules so that company A is reporting their assets using the same rules as company B. You don't want somebody using historical cost and somebody else using appraised value. Then you couldn't have that comparability. Okay. Now, as I mentioned, the marketable securities, they do get recorded at their fair value. So if you bought a whole bunch of Apple stock and you bought it for $5,000, and at the end of the year, it had appreciated in value and now it's worth 20,000, you can write that up. Okay, so different rules for different types of assets, and that's this whole language of the financial statements. Okay, so we kind of already covered that. We talk about borrowing. And you're probably aware of this. So when you talk about an asset and we talk about future economic benefits, assets, when you see the word receivable, that's pretty synonymous with an asset, because that's something that someone else owes you. That means you loaned money to somebody or you extended credit to someone and now they're going to pay you back. So in the future, you will have that asset, you'll have that cash coming in. It's receivable to you. On the other hand, when you look at a set of financial statements and you see the word payable, whether you see accounts payable or notes payable, you know that that's a debt. You borrowed money, whether it's long-term or short-term, and that payable means in the future you have to pay up. So it's just little nuances with the words, receivables versus payables. Okay, so our current liabilities, just to contrast these with assets. So as I said, assets are in order of liquidity, and your liabilities are going to be listed in order of maturity. So those that are coming due first get listed sooner. You know, they're first up on your in your liability section. And then those long-term ones obviously wouldn't, if they're not going to be due within a year, then you can throw them down into the category of a non-current liability. Okay, so here's some common current liabilities out there. Accounts payable, if you owe your vendors. Accrued liabilities, and I'm going to leave that one till we get to the accruals. I do want to stop for a second at deferred unearned revenue. I think some of you may be dealing with this. Let's say you have agreed, let's say you have an interior design business and you've signed a contract with a client and you require a down payment of 50% on the front end. So they give you the cash up front, and look what happens. You call that deferred, deferred or unearned revenue because you haven't provided the service yet. We're going to learn that revenue can only be recorded when it is earned. You have provided the inventory or the service. So just like by putting the word prepaid in front of the word expense, you create an asset. When I put the word deferred or unearned in front of the word revenue, you create a liability. And then our long-term liabilities, these are the ones that are going to be paid beyond 1 year from the balance sheet date. So some of you might have borrowed money from the bank and you don't have to pay it back for 2 years, 5 years. Some of you out there, as you grow your business, you're going to see you may have some warranty obligations that are long-term. You might have a warranty on your product for 2 years or 5 years. And so that would, of course, be long-term. Okay, the owner's equity statement, this, we're not going to focus on this, but I want to show you how it links the income statement to the balance sheet. So beginning owner's equity, let's say you started your business with $10,000 and during your first year, you earned $5,000 in net income and you didn't take any withdrawals, then your ending owner's equity would be $15,000 at the end of the year. And the ending balance is what would show up on your balance sheet, right? So the net income comes off your income statement, your owner's equity is on the balance sheet. And that's how that owner's equity balance is always changing by whether you've made money, right? Net income or net loss. And then if you took any draws out of the business. So that's how that one works. Quick look, I just want to call your attention to the term gross profit. This is only going to apply for those of you that have inventory. So you will start off your income statement with your revenues, and deducted from that is this line item called cost of goods sold. So what I mean by that, let's say that you are selling your product for $15 a unit, but you bought it for $12. Okay, so so that the cost of goods sold is $12. Your revenue is $15. So the gross profit is $3. And then from that is expected to cover all your other expenses. So if you don't have a product, you don't have to worry about cost of goods sold. So a lot of analysis can be done by looking at that gross profit margin. You want that to be as high as possible, right? Okay, so I know there's so much to cover. All right, let's quickly talk about the income statement here. So as I mentioned, the categories of revenue that you can have. So on an income statement, you have revenues and expenses. So most of you are going to either have sales revenues, or you could have service revenue for providing your service, or fee revenue. If you're renting property or you have interest, they're just other examples. These are typical expenses that you would have, right? Most of you are familiar and would have those types of expenses. Now, here's this accrual accounting thing, which I think is very, very important for us to get our arms around tonight, because I've seen too many of my small businesses just do everything on a cash basis, which really misrepresents your operations. Okay, so accrual accounting is required under generally accepted accounting principles. That's the accounting police. Okay, so if you ever had to be audited or whatever, they would expect to see that you've done your accounting using full accrual accounting. And the rules for accrual accounting are pretty straightforward. Your revenue, you only record it when earned, and your expenses only when incurred. Now, what that means is you do not consider when the cash comes in or when the cash goes out. So I have so many of my clients say, they do a job and they don't have the cash yet, and so they don't record the revenue. They're entitled to that revenue, they just haven't collected it yet. So full accrual accounting would say, recognize the revenue at the time you provide the service, set up a receivable, and then the same thing with the expenses. Let's say that your employees have worked for 2 weeks, they get paid every other week, and payday is on a Monday, but the end of the period is on Friday. Well, you don't wait until Monday to record the salary expense. You have to accrue it as of the end of the accounting period. You owe those workers that, their wages at that time. That's an expense of your business. You have already incurred that expense. The recognition of expense does not go with when you make the payment. And so many small businesses are not doing that. Okay, they're kind of mixing apples and oranges. So I've got 2 examples here, on one for revenue and one for expense. So let's talk about this. There's 3 points in time when the cash can be coming in. So if the cash comes in before you provide the inventory or the service, you have a liability. You have what we call unearned or deferred revenue. You've got the cash, but you haven't earned it yet, right? So you've got to show the cash on your balance sheet as an asset, but you also have to show a liability because you owe that customer either the service, whatever service you're doing, or the inventory. Now, if you provide the service, so let's say point of sale transaction, if somebody comes into your store today and they purchase inventory from you and they give you cash, well, you've got the cash and you have the revenue and they're in the same period, right? And so that one's straightforward. That's probably what some of you are doing. Now, the third one, you have provided the service. Let's say let's say you're doing tax returns for somebody. You've done their tax return and you haven't billed them yet. You haven't sent them the invoice. Do you have revenue? You sure do. You've provided the service. Revenue has been earned. So you need to record a receivable even though you don't have the cash. The cash is coming in 20 days from now. So, be aware of that at month end, that you've stayed within the boundaries of that accrual accounting. Now, on the expense side, you've got the same thing going on. Let's say that you paid, let's go back to my insurance example. January 1st, you paid for that 1-year insurance premium. And so you don't have an expense then, right? You have a prepaid asset. So you wouldn't recognize the expense on January 1st. You wouldn't start recognizing it until 30 days goes by. The easy one is the one in the middle. You went out there and let's say you paid for some advertising, right? And you advertise, whether internet, on the radio, whatever it is. And so you've got advertising expense and you've decreased your cash and it's all in the same period. So that expense is recognized then. Third example is, let's say that you've incurred that expense, like I mentioned before with paying the employees, right? They've worked for you, but payday isn't until Monday, but the end of the period is Friday. You've got to recognize that expense on Friday, right? You've already incurred that cost to generate the revenue, even though you're not going to make that payment until Monday. So once again, you've got to stay within the boundaries of this accrual accounting in order for it to make sense. So here's a mini income statement. This is a service organization. It's our furniture refinishers. There's my revenue. There's some expenses, typical operating expenses that you would have. And as you go down, we kind of do this as the descending staircase. If you think of an income statement, that's what's happening. Your revenue is always at the top, and you start deducting your expenses. And we actually can have further classifications. Typical operating things go under operating expenses. Things that are outside of normal operations, like maybe interest expense on a loan that you're paying, goes in other. And then you must show something called pre-tax income. And income tax expense is so important, it gets its separate line item on an income statement. It does not get lumped up there with operating expenses and other expenses. It gets its own line item. And then finally, you get to net income. So the math on this, you would take the 215 at the top, right? You would deduct the 162 of operating expenses, and you get to that subcategory called operating income of 53. You deduct 1,000 more of interest expense to get to pre-tax income of 52. And then finally, your last step there, you pull out the $11,000 of income tax expense, and there you are, bottom line net income, 41,000. Now, be aware that that net income number is not a cash number. It's an accrual number. That $41,000 did not mean that you collected $41,000 in cash during the year ended December 31st. Because inside of that service revenue of 215 might be some sales or some services that you have provided where the customer hasn't paid you yet, right? And likewise for expenses, there could be some expenses that you have incurred, but you haven't paid for them yet. So just, to be clear, the income statement, it's an accrual number. It is not a cash number. And that's a very important rule that should be observed out there. Okay, cash flow statement. Oh, you know what? Let me do something. I want to illustrate something. I've got an exercise for you, and I hope you find this useful here. Okay, so ladies, bear with me while I find something to share my screen. Let's see. Oops, hold on. Okay, does everybody see that exercise? Exercise number 1.
Yes, we can see it.
Okay, thank you. Okay, so what I want you to do, let's go through these slow here. Let's see if I really got this point across. I hope I did. So we have the Alpha Company beginning operations on October 1st, and we have some transactions here. So the first transaction says that the owner invested $28,000 in the business. So we have two things to deal with here. The first thing we have to do is to determine what financial statement this transaction affected. The owner contributing $28,000. Is it revenue? Is it an expense? Is it balance sheet, income statement? Well, cash coming in, your cash increased and your owner's equity increased, but there's no effect on your profit and loss, right? It's just assets. And the second one, inventory costing $10,000 was purchased. And here's this accrual thing. So you got the inventory. They delivered $10,000 in inventory to you. but you only had to put down $600, and the rest they're going to give you 30 days to pay off. Okay, so think about that. You have an asset, you have inventory, you've spent some cash, but you also have debt, right? Now you have a liability. Now you owe that vendor for the inventory, but guess what? You don't have any revenue yet. You're not going to have any revenue until you sell the product. So we have two transactions, and neither of those transactions is going to show up on your income statement. Those two are only showing up on your balance sheet. Okay, hopefully that's making sense to you. Now, the third one, we bought some equipment, and we also put down 1/4 in cash, right? We put down $2,000 in cash, and then the rest we borrowed money for. Now we're going to ignore the loan interest on that. But when we bought that equipment, remember we were looking at the non-current assets, and we said you had a decision to make. You had to determine its useful life and therefore depreciate it. Well, I'm doing this before or for you. I've already determined that for 1 month, the depreciation on that equipment would be $8,000. Now, depreciation expense is on the income statement because it's an expense. However, the equipment is an asset, the cash is an asset, and the note payable is an asset. So there's only one little piece of information there that is affecting your income statement, and that's your $400, you see? And so we've got cash coming in and out, but it doesn't necessarily represent an expense or revenue, okay? That kind of makes sense? All right, number 4, we're gonna put all this together in a minute. So you might want to put a little check mark next to number 4. Or number 3. That's my first expense item that I have. Now, number 4, does this look familiar to you? I paid 3 months of rent in advance, right? October 1st, I paid my rent for October, November, and December. And the total amount was $2,700. So doing the math, that's $900 a month. And at the end of October, I've only used up, so let me back up. On October 1st, when I paid that rent, I have prepaid rent, just like I had prepaid insurance. And so that prepaid rent on October 1st would be $2,700. But on October 31st, I have used up 1 month of that rent. So number 4, this is that whole accrual thing. Number 4, I have $900 of rent expense, and I have $1,800 of prepaid rent that's going to get me through November and December. So right now, you can say I've got $400 from transaction number 3 as an expense, $900 from transaction number 4 as an expense, and I don't have any revenue yet. So I'm not doing so hot. Now I get to number 5, and I have cash sales during the month. And I see that, and that's $6,300. So that's great. That means I sold inventory and I received all $6,300 in cash at the same time. However, the cost of those inventory items that I sold was $3,900. So my gross profit, remember I talked about gross profit, I would take the $6,300 and I would subtract the $3,900 and I would have $2,400 gross profit. But the point is, I would take that $6,300 and I would put that on my income statement along with the $3,900 as cost of sales. So now I'm adding to things on my income statement. Number 6, I had some more sales, but I didn't get any cash. You see, this is where I've earned the revenue, but I've not collected any cash. So I do have revenue of $7,500, but I also have an accounts receivable of $7,500. And the cost of that inventory was $44,000. So I have more cost, right? And then finally, the last piece of this accrual accounting is that my employees, they earned, or I owe them $3,700 for their work for this month, but I've only paid them $3,300 at the end of the month the other $400 will be paid next week, okay, in November. So on this particular one, my wage expense is the full $3,700, not just the $3,300 that I've paid. Is that clear? That's a mistake I see happening, you know, frequently enough, that people say, oh, my expense is just the cash amount. No, it's not. It's what you've incurred. You owe them 37, you've only paid them 33. So your full expense is $3,700. Okay, so let me move down here. So based on those 7 transactions, I want to determine what I would show on my income statement for the month of October using accrual accounting. So if we had more time, we could play around with this, but I'm going to cut to the chase here. And this is what my income statement would look like. There's my cash sales and my credit sales. And I've got 13.8, right? And then I've got my expenses. I have those 2 cost of sales, depreciation, rent, and wages. So for the period under accrual accounting, I have net income of 500. Very different than how much cash came in and how much cash went out, right? That's my whole point of this, that you understand the difference between accrual and cash. So your income statement needs to be accrual and not cash. Okay, let me switch back. To my PowerPoint. Okay. The PowerPoint back up?
No.
No, uh-oh.
And we're almost at the 10-minute mark, Lynn.
Okay, well, you know what? Let me, 10 minutes for questions and all?
Yes, ma'am.
Okay, well, why don't we call it a night there? Yeah, so let me see what yeah, go ahead.
So the first question we have from Elaine, way back at the very beginning. So financial statements are actual and budget is estimated? Question mark.
That's correct.
Okay.
Yes.
Lisa A asks, what about digital inventory? Is that considered an asset? Our inventory consists of digital products that exist online.
Digital products. Can you clarify that and give me
Lisa, go ahead and pop on.
Hi, we have things that are documents that are stored online. They are our inventory and we can sell them repeatedly. Would those be considered an asset?
Yes, but my question is how your valuation of them, how are you deciding what the value is?
I don't have an answer for that one yet. Marquita, do you?
So how do you determine the initial cost of that inventory? So for example, if I went out and bought, let's say I was selling tables and I bought a table for $50, I know that the unit cost is $50. What is the cost of one of your units of digital inventory?
Oh, I see what you're saying. So it's the time we pay a person to create the digital product, and then we put a price on it, and then we can resell that same product again and again.
Okay, so the cost, what you pay to get that inventory, that's your asset. The selling price, you can't record your inventory at what you're going to charge your customers.
Say that again one more time.
Okay, so whatever cost goes into creating that inventory, whatever you have to pay out to get that inventory, that is the asset value. That goes on your balance sheet as the cost. And then, so, you know, if it's $50 a unit and you turn around and sell it for $80 a unit, you can't value the inventory at what you're going to charge your customer. It can only be for the cost that you have into it.
Got it. Thank you.
You're welcome.
So Vanessa said, do you recommend any specific software for books, like i.e. QuickBooks, Xero, Adaptive Planning?
It's a great question. Most of my clients out there, from, you know, my $100 million one down to my $100,000 one, they've actually been very happy with QuickBooks. QuickBooks just seems to be improving, and I mean, it kind of depends if you've got inventory. I know there's different packages that QuickBooks has, whether, you know, you're selling inventory or you're just providing a service, but it seems to be user friendly. My clients that have like basically no accounting have been able to use it quite effectively and get up and running with it, and it's certainly very cost effective. So you know, that's really whatever, if you're happy with the type of reports that it produces, that should be one of the overriding you know, conditions for choosing it as well. Because sometimes people don't like the report formats in QuickBooks, and then they have to kind of augment that with some off book, you know, or off some Excel spreadsheets, or they have to go in there and reinvent the wheel. So you want to make it as painless as possible.
Okay, great. Elaine had another question. Would copyrights go under intangible assets?
That's correct. Copyrights are intangible assets. And they get amortized. Okay, and they have a legal life of 70 years after the death of the artist. So if that person hasn't died yet, I mean, that, you know, it's going to continue to be amortized.
Okay, great. So Vanessa had another question. Earlier, you stated that assets versus liabilities, that investors want to see more assets, meaning you're more likely to get the loan. So what are other things that on the P&L and balance sheet are they looking for approval wise? Do you think investing in Dun and Bradstreet to create a company credit is best, or should we let the company financials speak for itself if it's a profitable company?
Yeah, I think the company financials can speak for themselves. I think you're going to give them access to the slides. So at the end, I had some slides that dealt with how you can use these, how creditors can use these financial statements for loans. And we talk about liquidity. We have certain ratios that are out there, like debt equity ratio is a big thing that the bank looks for. So once again, you look at the relationship, you would take your total liabilities and divide it by your total equity. And you want to keep, you know, the lower that percentage is, the better. And so those are things that the bank looks at. They also look at turnovers. So I've got some calculations on there for accounts receivable turnover and inventory turnover. So a bank, if they see that you've got receivables, they want to know quickly, how long is it going to take you to collect on those receivables? They don't want to find out it's taken you 200 days to collect your receivables. So they can quickly take your balance sheet and income statement, and they can do that calculation. You don't have to get Dun & Bradstreet or anybody to do that. You can do that, and you can see that right on there. And I've got that calculation in the slide. Same thing for inventory turnover. The turnover means how fast are you selling the inventory? How fast are you collecting the receivables? And you can convert that from, you know, the more times you turn it over, the healthier you are. That means the faster you're going to be collecting the cash. So yeah, they look also at your quick assets. So they would rather see that you have quick assets are defined as cash, accounts receivable, and marketable securities. Inventory is not considered a quick asset because sometimes you can't quickly sell it. So a banker is going to look, and they're going to see that ratio of quick assets to your current liabilities. And they'd like to see that to be like a 1.5-to-1 ratio, or current assets to current liabilities, a 2-to-1 ratio, that kind of thing.
Okay, great. So Marquita wanted to know, how does she calculate cost of goods sales for digital products that have an unlimited shelf life? She says, in other words, I can calculate the first year, but after that, what do I do?
Wow. I've never really encountered that digital to know. I mean, I guess you would have to, I could do some more research, and you can give her my email and we can communicate, but I'm thinking that based on similar arrangements, that they would expect you to make an estimate of how long that digital inventory, might be in existence. Like you would have to come up with, to have to spread that out over, whatever time period that is, and come up with a per unit cost. So every time you sell one of them, if you came up with a per unit cost of $40 and you're selling it for $60, that's going to be in effect over however long you're getting benefit from that particular item. I don't know if you have to update that inventory with changes in technology, but it's going to involve estimates, is what I'm trying to say. Yours is not as clear cut as somebody going out there and buying a table and reselling it. So, I'll be happy to do some research for you and see if I can get you some better answers.
Okay, great. Thank you so much.
You're
We know
welcome.
it's challenging, but there's so many digital products like ebooks and webinars, things like
Yeah.
that. How do you get the price of those is what
Well,
we're
I can probably get you some information. So get my contact info and I'll be glad to help you.
Thank you.
Mhm.
And then Marcia asks, how would I recognize expenses for a sale of a package with 10 sessions and the client pays up front? So sessions are held on a weekly basis and may carry over the next month.
Okay, so that's a little easier. So if you collect that in advance, then you've got to do it like pro rata. You can, as each session expires, you have that session, you would, so if you do 5 of them in this month and there were 10 total, you would recognize half of them in this period and half of them in the next period. Revenue recognition is one of the hottest areas of accounting, and it's one of the most difficult. And the reason that is because there's been, I hate to say this, so much fraud associated with revenue recognition. So they've come up with new pronouncements on how to recognize, revenue on that. So, but I just know from even people like Jerry Jones, who's selling cowboy tickets, when he collects all that money up front, when he sells his season tickets, he can't recognize that immediately. As each football game is played, he has to recognize that portion of it. Whether there's 16 game season, he would record 1/16 in that month. Okay, so yours would be similar to that.
Okay, great. And then Tracy, this one was for you. Laura wanted to know if there were going to be any forms or formats that they can use like we did, like the business plan.
Only one we have right now is the business plan, but if there was something else, Laura, you were looking for, just reach out. And you want something like example, like a marketing plan or something for the financials, or? Okay, that'll be great.
I'll reach out.
Okay, that'll be great. We did try to do all of this in a progression. Financials are usually one of the most difficult parts for most people. So we wanted Lynn here early so you can get that and those numbers together for your business plan. But if there are other things anybody else needs, always feel free to reach out.
That was my last question, Tracy.
Okay, great. Lynn, that was fantastic. Thank you so much. And I love it that they threw some tough questions at you.
They did. You stumped me, Marquita. You got me good.
So that was great. Thank you so much. We enjoyed having you. Next week, we're going to have business entities. How do they work and do you need one? So that will be next Tuesday at the same time. I think a lot of you have already registered for all of them. So thank you so much. Again, Lynn, this is a lot of information to
I
absorb.
know. So next time, maybe you should have me for 2 of them, right? Back to back, because I hate to rush, and I know I talk fast. So I apologize for that, but there's just a lot out there.
Yeah, no, but it was great. We really need all that information. So thank you, everyone. Have a great evening, and we look forward to seeing you again next week.
Good night.
Good night.
Hi, this is Vanessa. I had a question.
Yes.
I am not a part of the Start Her, but I was just very interested in this. I am a business owner and I just want to get a little bit more information. So I think it was Laura that said something about a business plan that you gave out last time. Is that available to everybody or just the
No, you
participants?
can get that as well. We have both a paper one that you can fill in, and then also a live plan business plan template. I'll put my email down there, and if you want to email me, I can set you up with an account.
Okay, sounds good. Thank you so much.
And then feel free to reach out if you have questions on that or want to go over anything. I also do business advising. So if you're, I can send you the link for that if you're interested as well. And I can tell you a little more about the business plan and how it works as well.
Okay, so I just asked for that through the email?
Yeah, that'll be fine.
Awesome, sounds good. Thank you so much.
You bet. Thank you. And congratulations again.
Thank you. I'm sure to take a picture and show you on the keyboard.
There you go. Thank you.
Have a good night.
You bet.